Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, June 24th. Well, after last Friday's action and video where we pointed out some real negative sentiment as well as action in the market, and we questioned whether it was enough of negative sentiment and poor action to spark a little rally, we did see that this week. The nice thing is the breadth was across multiple sectors. The only sector really not getting involved was energy, which continued to be under pressure. But we saw a nice breadth. Some people look at the NYSE breadth indicator. How many issues are up versus how many issues are down. About 3 o'clock today, it was tracking just north of 90% up. That's an indicator that often is known as a breadth thrust indicator. Taken by itself, it's not as important as taken as a piece of a puzzle. So it was nice to see that kind of breadth. What did we do this week? We didn't make many adjustments to the portfolios. In the international portfolio, we did trim back further on Europe. We sold Germany. We're sitting at about 13% cash in that strategy, and we are underweight Europe. One of the areas that we added to this week was China. MCHI is what we play that allocation with. In terms of tactical trend, we did add a piece yesterday, to our Berkshire Hathaway position. Why? Why did we buy Berkshire Hathaway in a hole with pressure on it yesterday? You hear me often talk about weekly momentum. And it's an indicator we watch for extremes. Momentum that sits week to week in the, what John likes to call the belly of the curve, doesn't do much for us action-wise. But when you see a stock that has exhibited strong relative strength, Berkshire Hathaway, up until June, get 120% oversold on our weekly momentum indicator, we have to close our eyes and buy. It's as easy as that. No research, no fundamental work, no macro work. Strong relative strength names that have outperformed the market will give you an opportunity, shorter term, when they get extremely oversold. So we bought a 4% slug. That does take our Berkshire up to about a 14% piece. You know, that's one of the things that's been troubling this year, and why you can't always fight last week's battle or last year's battle or last bear market's battle. You've been able, even in 08, go back to when it was trading in 2000, 2001, 2002, you were able to hide in names like Berkshire Hathaway. Not this year. Some of the strongest balance sheet names that we talk about from time to time on this video as cash hogs, cash cows, big cash flow, they've been hit just like everybody else. I do think those are names you can return and add to. I'll be surprised if that kind of cash generating machine doesn't give these companies opportunities to add to their portfolio, whether it's Microsoft, Berkshire, a number of others that create such dynamic cash flow. We'll keep looking in that area. We had two things go right of the three we've been speaking about, right? Oil prices, real headache. Interest rates, real headache. US dollar, real headache. At least this week, we saw oil come down off that sticky 118 to 120 area 10 days ago. Did trade as low as 102 a barrel, West Texas. Popped up a bit today to that 106, 107 range. Interest rates, 10 days ago, 10-year Treasury spiked to 350. Closed up today in the 312 area. What do these two things allow? They allow the markets to breathe a little bit. Now the dollar remains at this critical level, and it makes a little headway, pulls back. It's really one I'm watching daily. You've heard companies like Adobe and Microsoft say the dollar will pressure their earnings going forward. If that dollar can pull back a bit, maybe the rally can get some legs. We'll see. Now we're going to go over to the Moose. John's going to tell you what happened in the world of rates and bonds.
Hi, it's John Mousseau. I'm the Director of Fixed Income and CEO at Cumberland Advisors. It is Friday afternoon on June 24th. And this week in bonds, we saw yields drop. Saw the 30-year Treasury bond go from basically a 3.28 down to a 3.25. The 10-year bond went from a 3.23 down to a 3.12. And even the 5-year bond went down even more from a 3.34 to a 3.17. Pretty big drop there. What was going on this week? What was going on was we heard Jay Powell talk that there were definitely recession risks in what the Fed was doing in terms of raising rates. They realized that as a risk. That is a risk of trying to fix the inflation problem. Sometimes the market does the work for the Fed. That may be going on right now. We have one chart here showing the CRB, the Commodity Bureau Index, broad base of commodities. You can see how this has started to roll over and drop precipitously. That also started to go up well before we saw the inflation numbers to go up. So as you see these commodities, and this does not necessarily include food and energy, which are included, but they are the big drivers, of course, of an inflation. They're still high. But other things have turned down, whether you want to talk about things like lumber or copper or, other inputs into things. They have started to turn down. You look at things like we've talked about housing starts. They have turned down. Certainly, new home sales have dropped 6 months in a row. Existing home sales have dropped 4 months in a row. We're going to continue to watch that. On the Muni side this week, we saw yields drop even more than Treasuries did. On the AAA scale, the long Muni bond AAA scale is now down equal to Treasuries. It had been above that for a while. We know that was part of the reflection of all the massive amounts of liquidations we saw in municipal bond funds. Again, it was a negative week in municipal bond funds, probably $1.5 billion of liquidations. That is less than it was last week, which was a bad week with about $5 billion and change. So we take this as a pretty good sign. The muni market did very well this week with good response on deals on a week that was probably a little less in supply because of the Juneteenth holiday earlier in the week. But we take that as constructive. And we're also going into the biggest rollover period during the year for municipal bonds, for matured bonds, called bonds, coupon payments, and that is July 1st. And so we would expect to see the municipal market, if we don't get any curveballs thrown, to probably ratchet ahead and do okay as you head into the middle part of the summer. We're going to continue to watch things like initial jobless claims. They've started to creep up a little bit. We saw the University of Michigan survey, which is a survey of people's basically sentiments on the economy. That has dropped over and is at one of the really low ratings we've seen in a long time, down at 50. It was at 85 just a year ago. So all of these signs, not by themselves mean anything, but collectively, they're telling us that even though inflation is high, we think things have already started to peak from a business standpoint and are starting to slow down somewhat. And that should be pretty good for bond yields kind of coming back down, reverting to the mean over time. So we're constructive on bonds going forward from these levels. We hope everybody has a great weekend. Thanks.
Thank you, John. Great information. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. We'll see you next Friday.